Okay, so I'm going to show you how to project forward a few of the items that we're going to have and see to make sure that we have enough, because if we do not have enough fixed assets and current assets and all our assets, then we're not going to be able to keep our growth as we would like it to be. So here's what I got. Sales revenue, I put in $100. Cash costs, let's say they were $65. Depreciation, say it was $15. That makes my earnings before interest and tax equal to C3 minus C4 minus C5. 100 minus 65 minus 15, which is 20. I've assumed an interest rate of 10%, which I put over here, and I'm actually going to change the number format. Go over here to number, custom, 0%, and then put a quotation mark, space, of debt. Close the quotation mark. So now you can see that it says 10% of debt. Looks like words, but it's actually storing the number 10%, so I can multiply by it. So this is C19 times A7, and a $sign for the A means that if I copy and paste this over here, it'll always multiply by this A column. Earnings before tax, EBIT minus interest. And then taxes, I did the same thing as I did here. It is C8, the amount I have in pre-tax profit, multiplied by $sign A9, so it's always 30%. I'm going to make this so that it's clear. It's 30% of EBT. So quotation mark space of EBT. Okay. So this is a number, even though it doesn't look like it. Just the number formatting looks as it does. Now net income would be EBT minus taxes. I have $2 here in dividends, and once I subtract out the dividends, I would have my additions retained earnings be $752. So suppose at the time I also have 35 in current assets, 75 in fixed assets. That'll give me a total assets of 35 plus 75, 110. My current liabilities are 25. My debts are 64. Well, this leaves me with 110 in assets that's funded with 89 in some kind of liability. So the 21 is going to come from equity. Once the present's taken care of, I'm looking at next year, and I'm trying to figure out what am I going to need, how am I going to finance it. So I'm going to start off by saying I'm going to get a 10% growth rate in my sales. So this is going to be equal to the 100 multiplied by 1 plus the 10%, 110. Now my cash costs, I'm going to assume that they're a constant percentage of sales. So they're 65 over 100, or they would be 65 100ths of the new sales number, which is 110. So it's going up because it is 65%, 65 100ths of the 110. Now I'm going to use this formula every time I see percent of sales, which is here, and here, and here. And the only way I can do that is if I lock in this with the $sign for the 3, C3 and D3, so that this is always the one being referred to. So I'm going to copy this here, because not only is cash cost as a percent of sales, but current assets is a percent of sales, fixed assets is a percent of sales, current liabilities is a percent of sales. Okay. Now I've assumed that fixed assets make depreciation. So what I've assumed here is that depreciation is 15 of the 75. Well, of my new number of 8250, so I'm going to multiply that by 8250 to find out what my new depreciation would be, 1650. EBIT is great. I can just copy and paste this over because it's a formula. I can do the same thing for EBT, for net income, for additions to retained earnings, for total assets, and for equity. Now these numbers aren't right because I don't have interest put in, taxes, and so forth. I'm going to make an assumption I'm going to need to go through, and that is I'm going to say debt is not going to change. So that means it's going to be equal to this 64. Once I know the debts aren't going to change, now I can get interest. And so this formula is going to work. It is 640. It is D19, the new debt number, multiplied by 10%. Okay. Taxes, this is the same formula. It's 30% of this 1560. Now I have to make an assumption for dividends. Let's say I've decided I'm going to pay a $3 dividend. Oops, that would be 300. $3 dividend. That means I would have additions to retained earnings being $7.92. Well, my equity number here goes from 21 to 29. So this difference, let's put this right here, is $8.50. And that difference is partly coming from additions to retained earnings, which is $7.92. The remaining would have to be new capital raised. $0.58. So in order to have 10% growth with no change in my debt and giving out a $3 dividend and maintaining constant rates everywhere else, then I'm going to need 58 cents in new capital financing. Now I want to change some assumptions or look at what else I could do to do some experimenting. So I've decided here dividends are $3. This will give me new capital of 58 cents. What if I left it at 2? If I left it at 2, I could actually repurchase shares, or I could reduce the amount of capital by 42 cents. Or if I went to $1, I could pull $1.42 out. Okay. So in any case, I can keep examining what would happen here by changing my dividend policy. The dividend policy of 0 would mean I can pull $2.42 of equity out or repurchase those shares. Going back to the 3 for a minute, I get new capital of 58 cents that needs to be raised. What if I decide that instead of a 10% growth rate, I'm going to be getting a 7% growth rate? Well, if I get a 7% growth rate and I want to pay this $3 dividend, which is substantial, then my equity goes up by $5.95, and then but my additions to retained earnings is $7.50. So I could actually pull out $1.55. So you can see actually that the lower growth I have, the more I can pull out of my equity, because I'm not using that money, the money that I would be retaining, to grow these assets, to grow the business. That's why a lower growth rate makes it so that you can pull out more money. Now, what rate of return would it take in order for me not to need any new capital? I'm going to do that by going to Data. And there's two places to do this. One is in the what if analysis and the goal seek. The better spot is in Solver, but to do Solver you've got to go through the File and Options. Go to Add-ins, and you'll have Analysis Toolpack, which is right here. I've already got it included, so it's already got it added in. But you would do OK, and that would add it in. And so Solver just adds more variability, more customization that you can make. So I want to set this new capital number to 0 by changing that cell. Let's see what it says. A 9.18%. So 9.18% growth is going to make it so I can pay a $3 dividend and not need any new equity or actually any new debt. I've already decided that part. What if I wanted a $1.50 dividend? Now, use Solver again. I don't have to change anything because I'm just going to set this to 0 and make that the constraint. So I get an 11.3% growth in this case. Okay, what I've added from the first one is that now says difference because it actually is. So I've got a -5 here, which means that the intent is to pay out $5 of debts, pay $1.50 in dividends. I'm going to put some big note here. This is a variable I'm messing with. Okay. To be $1.50, and if I do that, then if I want to have no additional raised equity capital, then I would take a 4.75%. And I found that the same way I was before with the Solver and so forth. But I'm going to do some more variations. So difference of 5. Let's say that I want to have a dividend of $1. and I want the new capital I'm going to allow the new capital number to change. Instead of using the solver this time, just for variety, I'm going to use the what if analysis, the goal seek. I'm going to set this number here, the new capital number, to $1.25, and allow that to change this cell. So if I want to have $1 in dividends, pay off $5 in debt, and use $1.25 or raise $1.25 with the capital markets by selling shares of stock, then I could have a 7.21% growth. Now I can alter these and just keep experimenting with this variable, and this one, and looking at what happens here. Or I'm going to create another thing, which is a data table, which goes into this what if analysis data table. So what I'm going to do here is propose different levels of growth and how much new capital would be necessary. Okay, so first I'm just going to reference this cell, but then I'm going to show some others. So let's say it's 0% growth, 4% growth, 8% growth, 12%, 16%, and 20%. Now I could have as many of these as I want, but this is plenty. And I'm also going to look at what happens with my new capital, how much new capital that I need. Now this is assuming everything else is exactly like this, $1 in dividends, $5 paid off in debts. So with a 7.2% growth, I need to raise $1.25 in new capital. If I highlight this area right here, and if I go to my what if analysis data table, and this, my growth is in a column, so in the column I'm going to put what it is I'm going to allow to change, and that's going to be this. So I'm going to put in, essentially this is going to put in 0% there, 4%, 8%, 12, 16, and 20, and spit over here what it would do to this number right here. Alright, I'm going to put these in dollar signs so it's kind of easier to tell. So with the 0% growth, I could pay off $3.87. With 4%, I could pay off $1.03. With 8%, now I'm going to need new capital. And I knew the number was close to 8% because at 7.21% it flips over to being $1.25. 12%, 16, 20. So I can see what happens when one impacts works with another.